Today, under property's skin. Hello again, it's Martin North from Digital Finance and the Nucleus Wealth, the latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Damian Klassen from Nucleus Wealth. Hello, Damian.
Hi, Martin. Good to see you again.
Yeah, thanks very much for spending some time with us. And you've been doing some really interesting analysis on the whole question of property and investment returns and trends and all sorts of really interesting things. So I thought it'd be really good to have a catch-up chat.
Yeah, no, thanks for that. It's been getting some love letters, some hate letters, so it's all always good to.
Well, of course, if you take a position with regard to property, particularly if you're not going to be ultra bullish all the time, then you're going to get mixed feedback, aren't you?
Absolutely, I'm sure you get that all day long in your comment section.
I do, absolutely. So I'll let you lead off with the conversation because you've got control of the slides. So over to you.
Right. So I think where I wanted to start with this is just to have a look at some of the different alternative ways you can look at forecasting property, how those sort of what the key inputs are into those, and then start having a look at some scenarios before I actually move on to this housing tool that we built to try and I guess illustrate to people and let people play with it themselves and see what came out. Because where all this started from me was I had a friend of mine who was looking at buying a property, and they'd been to this online calculator, and they'd basically said, look, the online calculator tells me that they were trying to work out, do I rent or do I buy? And they'd show me the calculator and said, this is telling me to buy. You're saying rent. What's the difference? And this is an inner city Melbourne suburb, and so yields are very low. And so I went in there and I sort of went, okay, well, he was sort of paying about $800 or $900 a week in rent. And the property price was probably about $1.6 to $2 million in terms of that range. And I sort of thought it'd be touch and go, but the calculator said buy. And I thought, oh, well, that's a bit strange. Well, what happens if the rent wasn't $800 or $900? What happens if it was only $500? Still said buy. $200? Buy. Dropped it to $1 a month? Still says buy. And so it's that part, and that wasn't the only calculator. So that was the yourmortgage.com.au calculator. There's a whole bunch of them that sort of run under this, the rateseeker.com.au and a bunch of others all have the same thing. So you get the same story. So you put a low rent amount in, as long as you have a high property price value, it tells you to buy, because it basically says that the house price is going to go up by 7 to 10% per annum. And so if you've got $1 million house, it's going up at 7 to 10% per annum. You only have to borrow at 4%. Obviously, it's well worth gearing as much as you possibly can and buying.
So, Damian, I had a question on that. So those growth numbers, were they plumbed into the models, or were they ones that you could put in yourself?
I've changed the rent amount. That's all I did to both these calculators. So the calculators themselves do say, you can go in and change everything yourself. But no, I have literally just turned up and put a dollar figure in for the house price, and then reduce the rent.
Okay, so basically the point there is that the baseline assumption on some of those online calculators was there will be considerable capital growth in the property sector ahead.
Absolutely,
yep.
Yeah. And so all you're really doing is trading off between saying, well, if I'm going to buy a low-valued house for, say, $200,000 to $300,000, if you can find one somewhere, then the stamp duty and all these other fees sort of overwhelm the benefits. And so, yeah, so basically, as soon as you get a high enough house price, it will tell you to buy all day, every day, regardless of what you pay.
Okay.
And so that was where it sort of came from, is saying, well, how should you actually forecast property? If it's not just growing at that rate. And so that was one of those stats I was saying, well, if you come back and say, if house prices grew at 10% per annum for the next 20 years, and you kept wages and rents sort of growing at the same rates that they're growing at the moment, you'd find the median Sydney house price would be $7 million plus. Compared to your salary, that'd be about 45 times the median salary. If you wanted to get a ScoMo, 95% loan with only a 5% deposit, well, that would only take you 2 years worth of saving every cent of your pre-tax salary to get there. And even when you did, your mortgage payment's going to be 3 times. So I guess what I'm trying to draw out, and I've used a little bit of an extreme case, but you can't just plug a number into house price growth and assume that that's what you're going to get for the next 20 years or 10 years. So I sort of come at it from a few different ways. And I'll start by saying what I want to sort of assume is going to be true going forward. And I have my doubts over some of these, but let's assume for the sake of the argument that these are true. So the first one is the debt levels. Now I've got a chart up on screen just showing Australia at, of the developed countries. I think we're number 2. I've sort of taken Switzerland off this, so it's just showing that debt's grown dramatically. We're well over 100% household debt to GDP. I'm positing there's some limit on that, but let's assume for the moment that that's not going to be a constraint, that we are going to be, that, if you want to keep lending, that you'll be able to. And most of the studies have shown pretty clearly that more debt leads to higher house prices. The other thing is unemployment, and one that I just want to highlight again. I've got another chart showing up here, a combined line of the Sydney and Melbourne property prices from 2014 to 2018, when right throughout that sort of the last big boom that we had in property prices. Now, over the same time period, Perth prices is the light blue line, and that actually went backwards. So you had exactly the same fiscal conditions, exactly the same interest rates, all those types of factors. The big difference was unemployment rose in Perth. And so, I just want to keep people remembering that, the grand days of 2014 to 2019, where house prices had this massive rise, was, it was partly due to unemployment falling as well. And so if unemployment goes the wrong way, then you can throw a lot of this analysis out the window. So, but at the moment we're assuming debt's going to be fine, employment's going to be fine, and then you've got all your other factors that sort of go into it. Very generous tax breaks for Australian housing. There's limited supply. You've got historically high immigration levels. Stamp duties are high, and land taxes are relatively low. We continue to tolerate money laundering in Australian housing and foreign demand. So let's just assume all that stays the same and none of it changes. So now we're saying, how can we generate a reasonable forecast of what we think house prices are worth? And I came back to saying, I think it's 4 factors. First is saying it's some sort of relative cost between renting and mortgage. Most people, most owners, when they sit down, it's about saying, well, if it's going to cost me $1,000 to rent a property, or I can get a week, or I can get a home loan for the same price, then I'm more likely to get a home loan. If the home loan is going to cost me $2,000 a week, then I'm going to be less likely to get the home loan for that. So that's the sort of first assumption I'm making. The second one is then the affordability of a mortgage makes a difference as well in terms of wages. So if we're not getting wage growth, it's very hard for people to afford it. And if they have to keep spending more and more of their wages on a mortgage, then people again are going to drift back to renting rather than taking a mortgage out. The affordability of deposit, in terms of saying, well, there has to be some relationship between people just being able to save enough. So interest rates are falling, which helps you being able to pay your mortgage, but you actually need to save up a deposit to get the mortgage. And then finally, the returns to investors. So I'm going to focus on the first 2 a little bit. I've got some charts up now just showing this mortgage cost to rent for Sydney houses, Melbourne houses, and Sydney and Melbourne units. When we get to the calculator, this is available for all the different states. So you can go through and change that around. So the idea was letting people sort of at the calculator to see what the numbers came out for their sort of preferred investment area. And with this, you can pretty clearly see that, certainly over the last 20, 30 years, that if you get below that sort of 100% on houses for Sydney or Melbourne, that seems to be a low point for it, and 200% seems to be about the peak, where it doesn't seem to go past that. In 1990, we sort of touched off those levels. In the 2007, touched off those levels, and then again in that 2012 period, and up to 2018, sort of got close. And so I guess I'm sort of looking upon those as a limit. For units, it seems to be a little bit lower. Maybe it's 150%, that type of range. But there's obviously some sort of relationship between people can, if people have a choice between renting or taking a mortgage, they will make an option if the price pushes in one direction or the other. The second thing that helps with that one is rent growth, and I just want to highlight this, is rent growth is actually a pretty stable series. So I've got here I've actually taken out inflation out of this series for the last sort of 40, 50 years. And you can see that real rental growth is pretty close to inflation. You get a little bit below it, you get a little bit above it, but on average, you sort of end up roughly at that inflation rate for rental growth. And also within that, this line doesn't really capture replacement and a change. Like the house you were renting in 1985 is not the same house that was being rented in 2015. And the amount of extra money that needs to be spent or change in composition that, the house from 50 years ago might have been the median house might have been a 3-bedroom fibro, now it's a 4-bedroom McMansion or whatever the case is. So rent growth, I guess where I'm getting to is it's a stable series. It's most likely below what the numbers you're looking at here, but you're not talking about getting sort of 20% rent growth and putting those types of numbers into your models is unrealistic. The next factor then is mortgage versus wages. And again, it's that part about saying, well, if people start putting more and more of their money into paying a mortgage, then eventually they get to the stage and they decide, right, maybe there's something better off to do with my money. Maybe I should just rent somewhere and if I need to buy food and put my kids through school and whatever it is. And so that's another one where it seems to be about 70 in Sydney. It seems to be about 75% of a median wage seems to be about the limit. In Melbourne, it looks to be a little bit lower than that. And again, on units, it's sort of lower again. But there's this idea that there's some sort of limit in terms of once too much of a salary is needed to go to meeting a mortgage, people will opt to do something else with their money and decide to rent. And that will sort of bring prices down to the level where you can. Or the flip side is, the other way with both these is if the RBA cuts rates, then the cost of a mortgage comes down and you can afford a better house. And I guess in the end, that's what I'm positing has happened over the last 20, 30 years is most of it's been that cut in the cost of a mortgage, which makes these more affordable, which then lets people buy bigger houses and spend more on a house. But we're down to, 1, 2, 3 rate cuts left, depending upon who you speak to and about how much the RBA can actually push through. So I guess what I'm saying is that story tends to be over now. So you can't really rely on that. And again, wage growth, I've got the 3-year average of wage growth, and we had the wages out again today, coming in at, I think about 2.2% growth, and we're running an inflation of, 1.8. So again, it's just showing that if you strip out inflation, wages again is a very, very stable series and sort of tends to grow a little bit above inflation without a lot of volatility. So I think I've had a few people say to me, oh yeah, but during the mining boom, people's wages can grow at 5 and 10 and 20%, and saying, well, in real wage terms, no, not really. And again, it's sort of been more getting that inflation kicked through. And so, so X that inflation, you really, there's not a lot of room to move on your wages. The third factor was this, can I afford a deposit? Now this one, I think a lot of people, and I've probably been guilty of this in the past about paying too much attention to this chart, about what's the house prices compared to wages. And if you go back far enough, they've sort of done analysis back in the early sort of 1900s and people were paying sort of 1 times their wage or less. And that's just gradually worked its way up. And now we're sort of paying, well, Sydney one here, I think about 12.5 times wages. I don't really know how high this figure can go. So a lot of this has come down to that falling mortgage rate. But I sort of feel as if this is one factor which, if I wanted to try and forecast house prices, it's very hard to do using this graph because can it go to 15 times, 20 times, 30 times? I don't know. And I'm not quite sure what limits that. I think for my part, whether people can afford a house is more important than whether they can afford the deposit, because I think the deposit, there's banks of mum and dad, and there's other types of ways that people can come up with a deposit. borrowing from friends and relatives and things like that. But the ongoing mortgage payment, I think, is a more importance. And then finally, investor rental returns. And this one again, I'm gonna just skip over this one, not because I don't think it's important. I do think investors getting a return on their money is very important. But for the last 10, 15 years, there's been about 60 to 70% of all investors have lost money on, or they've claimed a tax deduction from the ATO in terms of their ongoing expenses. And so I guess what I'm saying is I do think it is important for investors to make money, but I think at the moment almost all investors are buying because they think the property prices are going up, not buying because they think they're going to get a yield and an investment return on actually just owning the property. So I'm sort of throwing that aside, and I'm throwing that forth. Can they afford the deposit to the side? And saying, I just want to focus now on those first two factors. So the three ways I've then looked at it is saying, let's do three different scenarios. We go an economic boom where we have rents growing at about 6%, wages growing at 4%, inflation at 3%, and interest rates on their way back up to 7%. What I'm calling purgatory, which is basically just what we've seen over the last few years, just keeps going. So inflation and wages stay at sort of 2%. Rents sort of grow a little bit lower than inflation, and interest rates stay where they are. And then you go the economic bust scenario, where inflation falls further to sort of 1%, interest rates fall to maybe another 75 basis points, and then wage growth sort of falls to about 1%, and rents don't go anywhere. And so I'll show those in a minute on this calculator. I've sort of brought up the screen just to show you where you can get to. So it's off our website. There's a property calculator, or you can go to nucleuswealth.com/property-calculator. And the idea here is you start with what you're looking to buy. So let's say we're going for a house in Sydney. So we're going to select house. We'll pick our New South Wales data. Let's say we're going to spend, just to make the maths nice and easy, $1 million and a $200,000 deposit. By default, we'll set the rent to whatever the state rent is. So you can sort of hopefully see that rent changing as you click on different states, or if you change between units and houses. So we've just set that to the default rent for that one. And then we say we'll pick an economic outlook, looking for poor, low growth, moderate growth, or good. So let's go with the bullish version. And then you go through and then you say, okay, now how would I like to forecast that? Do I want to do a mortgage versus rent? Do I want to do mortgage versus wages, property price to wages, or rental yield? And you can see on the graph what the prior averages were, so the 10-year average or the 30-year average. And so let's say for you're going to do this mortgage versus full-time wages, and it's a boom time, so you think it's actually going to go back to sort of all-time highs, and we'll make it sort of 80%. And then you can see what that actually means for your property. So we've gone with quite a bullish outlook on that one. We can see that the property itself does increase. That's this sort of grey line. But the big issue is you're going to be out about $100,000 on your entry and exit costs in terms of just paying your stamp duties. And you're probably going to be, if you're borrowing money, you're going to be losing money year after year on your interest. So net over the whole time period, while the property itself is up, you'll actually lose money on that deal because you're not quite getting enough to offset the huge interest burden and the costs. And if you want to go in there and actually play around with it and have a look at those numbers, you can actually sort of hit this adjust assumptions, and you can go in and see, you can either play with those original assumptions I had and said, okay, well, we're assuming rental growth is going to grow at 5%. Let's make that higher or lower. You can see all the different costs, what are rates costing you, and body corporate if it is, and insurance and repairs and all those types of factors. You can play around with all those figures yourself to come up with a more accurate view. But I guess the story is coming out of this is that this scenario is very similar whether you pick different states or whatever. Sydney's the worst for it, but given the yields are so low. But it's the fact that even though you can come up with a scenario that where property goes up a little bit over the next little while, it's actually quite hard to come up with a scenario where if you're borrowing a lot of money, you're going to make money out of this, out of it, if you think that these factors will constrain it.
Well, Damon, that's really interesting because you took a relatively optimistic view, right, in terms of that scenario, and yet in real money terms, you were still underwater.
If you're borrowing.
Yeah.
If you borrowed to get it. And I think the big issue is the rising interest rates. So if you put that same scenario, but you said, interest rates didn't rise, they stayed where they were, now you're making bucket loads of money.
Yeah.
So the whole question is saying, if you think all these good things will happen, but interest rates won't go up, then you can rush out and buy property. But if you're expecting a good economic situation and interest rates not to rise, then you're limited by that.
And what's interesting about all of this is because we survey households and particularly property investors, right? And we calculate gross and net returns on property investment, right? From the information that people tell us. And it is really scary how few people are actually making any real returns. Even now, even at the current low interest rates, partly because, of course, they're borrowing, partly because they've got all these repair costs and other costs coming through. And in fact, the only reason that they're hanging in is because they get the tax breaks.
Yes, which in the end is, I've got a friend who keeps telling me their accountant keeps saying, you're making too much money, you need to get another property to, to reduce your taxable income. I'm like, mate, just tear it up and stick it on the fire. Give it to me. If you need to get rid of money, don't feel as if you have to waste it, on losing money, on a losing investment.
So what do you think the sort of the number one lesson then is from the research that you've done and from that model, which by the way is readily accessible to anybody who wants to go play with it?
Yeah, look, the key thing is, and what I was really trying to show is, you can't just assume property prices are going to go up at the current, or whatever rate they've gone up over the last few years. You need to look at why it's gone up. And in my view, the falling interest rates has been the biggest reason for it to go up. And so then going forward, if you don't have falling interest rates anymore, or if you can only fall another 75 basis points, then you've lost that tailwind, and it's in fact about to become a headwind. And so most of the sort of more benign scenarios, property investors will make money if you don't borrow. But it's very hard at the moment to come up with a scenario where you can beat your cost of capital on that. And keeping in mind as well that the round trip is probably close to 10% just to get in and get out. So it's all nice to say I've made money on property and I've made a 10% return, but that's probably only just covered your stamp duty and your exit costs and all the other entry costs that come about.
And that's consistent with my survey data, which basically says that most property investors are in it for the capital gains, right? Because they sort of assume magically that will always translate into being ahead, despite the fact that may not often be the case. And I'm also very interested in your earlier comment about there's a linkage between the size of the mortgage and credit availability and prices, because we see that in our modelling too. And I'm also noting that there's quite a significant story in terms of the rentals, because real rentals in some of the major centres are not growing at all. And that's because low inflation, and as you say, rentals and inflation are quite correlated, as of course our incomes to inflation pretty much at the moment. So all of those factors are in the mix.
Yeah, absolutely. And so and we sort of take the view that Australia's lagging the rest of the world in terms of the whole economic cycle. So we managed to keep our interest rates much higher than the rest of the world for much longer. And if you look at country after country, how they've just had to keep cutting and just not managed to get out of this low growth scenario, is then saying, well, what's special about Australia that means that we're going to all of a sudden change and hit the high growth scenario without having to go through that long process that most other countries have.
Which suggests that purgatory is probably the name of the game for at least a few years.
Yeah, unfortunately. And then you start overlaying some of the risks and you say, well, you look at coronavirus or other factors, there's very high corporate debt levels out there. Pretty much every time we see a corporate debt crisis, you hit recessions. So, there's a number of other sort of events out there so I guess I look at property and say there's lots of downside, there's not a lot of upside. And at this point in the cycle, when you're worried about cycles turning, you generally want to own liquid assets. You want to own things where you're saying, okay, well, if I'm going to take some risk, at least I know that if things start to go wrong, I can actually turn around and sell those quite quickly. And houses just aren't that type of asset.
So what would be your pick of the strategy if you were thinking of providing some agility and flexibility in the current environment?
Yeah, well, what we've got is we're actually quite underweight shares, both Aussie shares and international. We've probably got more international than, not probably, we do have a lot more international still than what we do Aussie. We've had a bit of US dollar exposure, and then government bonds. So I'm avoiding corporate bonds, so sticking with government bonds and cash. That's, I guess, a tactical view. That's probably how can I put this one? It's a much bigger topic in terms of the coronavirus, and what we see is tail risks there. And to me, it's not just a tail risk of will this be a global pandemic, which is on the cards, but not, you wouldn't be investing off the back of that just yet. But it's more the fact that we know what all the shutdowns have been, and we've seen that right throughout China and Australia. And so we're actually having a supply shock and a demand shock. And when you find companies in that situation who have high levels of debt, then there's a decent chance you're going to start seeing some corporate failures and some decent sized ones if this goes on for any length of time. And so we're positioned to say, well, everything's very expensive at the moment, but particularly stocks. We're happy to sit out of that, and if the worst happens, if the best happens, and it's solved and the solution and on we go, well, stocks are already very expensive and growth rates are already very low. We don't think we're giving up a lot, but we think at the moment there's a very good case for being quite defensive, because if the worst does happen, then there's a considerable downside, we think, in a number of those assets. So what are you seeing? What's your latest on all the corona stuff? What's your take?
Well, I'm quite negative as well. So I'm watching some of the real-time data. So things like pollution indices and some of the other information in terms of traffic flows and those sorts of things, which seem to me to be quite important. I'm also seeing through my SME surveys a lot of small businesses already being hit with not being able to shift goods to China, not be able to bring stuff back from China to maintain their, manufacturing business or whatever. So even now, on the ground locally in my surveys, I'm seeing some of that. And then we start seeing some of the bigger, Cochlear's warned. Clearly, BHP had a good result up to December, but, you sort of think, well, if the iron ore price goes down a bit, they could have some issues. And then we're seeing people like Apple saying, well, we're not sure now on the first quarter. So bit by bit, I think the bad news is coming out. And I still don't quite understand why it is that the markets, from a stock perspective, are so bullish. Because I am much more concerned and negative than the markets would actually lead you to be.
Yeah, because so in your surveys, you are starting to see. How about the consumer surveys? Are you seeing people worried about?
Oh well, that? the consumer sentiment was already really low, and now in the latest iterations over the last couple of weeks, that's also dropped further, and it's both a direct and an indirect correlation there. So, firstly, people are more concerned about their jobs than previously. They're basically saying they don't see any prospects of any wages increase, and the wage data that came out today again underscores that we're in a very, very slow cycle with it when it comes to wages, but also numbers of hours worked, so that's going backwards for lots of people, and so it's the underemployment as well as the people who can't get the work. And then the other thing that I'm seeing, and this is something which I didn't quite expect to see, retail we knew was weak, construction's weak, but I'm seeing other industry segments. So even the property sector, for example, which I would have thought would have been a little bit more buoyant now, is less so. And so, I'm beginning to see other people in other industries beginning to question what's going on. So I think consumers and small businesses are much more cautious than, again, what the markets might represent.
Yeah, and to me, that's the part where I'm like going, well, even if it does all get solved tomorrow, this caution is people aren't going to rush out and go, oh, yep, let me go and buy that new car now and let me go splurge on a house and a new sofa and all that. I think people have still got that, even if it was fixed tomorrow, there's a certain amount that's going to lose, and then
and if you take education or even tourism, you don't get some of that just displaced, right? That's lost. So
Yes.
effectively, you never get those flows. I think the other cornerstone is that I still believe many investors believe central banks will magically pull another rabbit out of a hat and will do more QE. Though I did note over the weekend the central bank in China was indicated that they might go more the austerity route rather than the stimulus route.
Yeah.
So
Yeah.
don't know.
I don't know. And well, the thing that gets me on that one, on the China, look, who knows? I mean, everyone I speak to overseas is like, oh no, China's going to come out with the biggest stimulus you've ever seen. You've got to buy iron ore now while you still can. And I'm like, but the thing is, I go back to 2008. They were saying we're over, we've got this whole thing unbalanced and we need to shift away. And property building's 3 times higher than that now. Like, it's just like, I'm not sure how much more they can stimulate.
Yep.
I guess where I'm coming to from that front is saying, even if they said we're going to build bridges and roads to everywhere, I don't think they've got the capability to do it.
Well, that was what was so interesting about the statements over the weekend, when they actually recognised that that wouldn't necessarily work. So they basically said our experiences of trying to do ever more stimulation and trying to get more construction hasn't worked very, very well. So therefore, we're going to be more cautious. We're much more selective if we do stimulate this time. And I'm not sure that message has actually been absorbed by the market as yet, because for me, that was a really important comment.
Or believed. I think that's the other thing.
Well, that's true. Yeah.
But I think there is a lot of I often talk about those with especially international investors, and for the most part they're like, they always say that. They've been saying that for 20 years. We need to rebalance, and they never do. So, and then there's some truth in that, but it's you sort of feel again, there's what's the limit? Can you have every single person in your house, in your economy, building things? And saying, well, probably not. You probably need to at least have some people doing other things. But
yeah. So I think the net conclusion is a time of uncertainty.
Yeah. And there was something else I was going to ask you as well. In the surveys, do you see? Because do you see much on the construction side? Do you get any feel for what's going on that or not?
I do, yes. So most of the data is from the SME sector. So that's really what I'm looking at. So I'm looking at the tradies and things like the proportion of work that they have and their forward books. It's still going backwards. So whilst everyone's been talking about construction's coming off the bottom and we're seeing more starts, a lot of the tradies who were working 6 days a week a year ago are now working 3 or 4 days a week, and they don't have much visibility of forward work. So the confidence levels, the other thing is that the rates of pay have gone down. So, the hourly rates, in other words, what you need to pay to get services is lower. And then the third is the geographic skew is quite interesting. So there was a huge boom in Brisbane, Sydney and Melbourne. And the biggest change over the last 12 months are in those 3 states on the downside. So in some of the other places, like in Hobart and in South Australia, there's a little bit of upside, but it's so small relative to the big downside in the local markets of Sydney, Melbourne, and particularly Brisbane. So my own view is that the construction sector is going to be in for at least a 12-month to 18-month continued grind.
I think the next 2 or 3 months are extreme. Well, I mean, we've taken a huge position for us. Is like we've taken a big swing at it, and we're sort of like, I feel as if we've hit the brace position, and now we're like going, just a minute, how come we haven't crashed yet?
Exactly right. And why isn't everybody else in the same boat? Yeah. It'll be interesting. Well, I appreciate that, and thank you very much for your time today.
Yeah, no worries. Thanks a lot.
Thanks. Have a great day. Cheers. Bye-bye.
Bye.
So there you have it, really interesting perspectives there from Damian. And I think there's an object lesson there about really being cautious about making those investment decisions with regard to property in the current environment. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.